Welcome back, everybody. Hope you enjoyed a little bit of a break from looking at the computer screen. We have a couple of questions we didn't answer from the last session, so I'll quickly deal with those. The first one is if a testamentary trust holds a property as tenants in common with a life interest for the survivor to continue to live in it, and there's a large mortgage owing the property, does 50% of the mortgage become a liability of the testamentary trust, or does the mortgage become the responsibility of the surviving borrower? The answer is a practical answer is that it depends on the bank. We have an estate at the moment where they'll probably let the existing mortgage run because they're comfortable that the parties involved in the testamentary trust are broadly in line with the interests of the surviving tenant in common, but I would think ultimately the bank will insist on a refinance. So that probably is what drives these things more than anything else. The matter of succession law, the testamentary trust takes its interest in the property subject to the mortgage, so it doesn't have to be responsible for the mortgage, but it doesn't get the benefit of the property unencumbered. And the second question was, can bloodline trusts be used successfully in other states, especially Victoria? And the answer is yes. It's not peculiar to any state. Their best use is intergenerational transfer. In other words, it won't help me if I decide that I'm having a bad time at home and want to use a bloodline trust to protect my assets from my wife. I'm on a hiding to nothing there, and there's plenty of case law along those lines, not involving bloodline trusts, but trusts in general and transferring assets in those circumstances. But yeah, it's not no barrier in relation to state borders on that issue. Might move on to the next paper. Now, in your synopses, there's actually a bundle of technical information on this particular paper and a separate technical issues synopsis for those of you who are interested. But the context of the paper is along the lines that really no plan survives the commencement of battle, and we all thought that General Patton was the author of that. I've done a little bit of Googling, and it was actually a fellow called Helmut von Moltke, who's a Prussian military commander from the 1800s. And his precise quote, at least in English, was, "No plan of operations reaches with any certainty beyond the first encounter with the enemy's main force." And what we're talking about here is that we do a lot of planning, but ultimately planning is not much good unless it can be enforced. And for us, that's part of our role is when our strategies in asset protection are challenged, then we're more than happy to act with the appropriate parties in enforcing those. So in that context, the agenda for this paper, and some of it has been covered in Paul's first paper today, and then Adrian's, so we're going to minimise our overlap there and focus on a little bit more detail in the what you might call clawback or look-back rules in bankruptcy and in the Corporations Act in relation to the use of secured debt strategy for both individuals and company to company. So we'll look at some legislation, we'll look at what asset protection means, and look at what assets would be available to a trustee in bankruptcy, and are there any exclusions of those. Again, look at the clawback provisions and some specific provisions along similar lines for corporations as well as individuals, and then some solutions. So a case study again, we all heard it, we all know about Rick and Helen. The numbers and the people haven't changed, nor have the figures. What we have added in here though is that there's self-managed superannuation involved, and in fact in the real case there was as well. Helen's superannuation entitlement in her self-managed fund is $450,000, and the trustees were Helen and her daughter Carol. So the two areas of legislation we'll look at is the Bankruptcy Act, and many of you will be familiar with that. Some of you will be less familiar with the clawback and the pool widening rules in the Corporations Act in relation to companies when they're acting in their own right or as trustee of a trust. Before we do that, there have been some changes which are relevant during the current COVID-19 scenario, and that is in extending the periods during which a person can be protected from a claim from the trustee in bankruptcy. In this case, looking at the Corporations Act and statutory demands, and protection for directors from personal liability from insolvent trading. For the Bankruptcy Act, we now have 6 months to respond to a petition in bankruptcy rather than 21 days. So there should be a creditor's petition and a debtor's petition in bankruptcy rather than 21 days. And you need to have a debt that's at least 20,000, not at least 5. So I guess the government recognising as a matter of policy that need to provide a little bit of breathing room for what they might consider as smaller debts in the hope that they can be resolved without or as we'll see in a moment, the Corporations Act. The definition of property for the Bankruptcy Act purposes includes real estate, so real property, also personal property of just about every description, and no matter where it is in the world, so long as it belongs to the individual who's looking at bankruptcy. And then the property of the bankrupt is what you might call divisible property, property able to be seized by the trustee in bankruptcy and be sold or divided amongst the creditors, and also any other property of the bankrupt even acquired during their bankruptcy. So be a little bit careful of that, and we've certainly had more than one example of a deceased estate delivering some benefits to a bankrupt at the worst possible time. So be very conscious that it doesn't just include assets at the date of bankruptcy, it can include other assets as well. So for those who are looking at what asset protection is about and why we're looking, who we're going to protect from, we talked this morning about protection from general creditors of an individual, general creditors of a business. We talked about in my last paper protection from a claim against a deceased estate. This paper is about protection from the rights and powers of a trustee in bankruptcy in relation to personal assets and a protection for liquidator in relation to company assets. We're all clear, I think, from Paul's paper about what assets would belong to an individual and what might be then seized by the trustee in bankruptcy, and that slide is self-explanatory. The assets to which the bankrupt may become entitled after bankruptcy include gifts, refunds, tax refunds, windfalls, and also assets accumulated from income earned during bankruptcy, although that would be a pretty tough ask in most circumstances to earn enough income not just to survive but to accumulate other things. This slide is a little hard to read, but it talks about, I'll just get it up on my paper, it's probably easier to read on your synopsis. And it talks about, well, when precisely do you become bankrupt? And there's two scenarios. One is on a debtor's petition, another is on a creditor's petition. Most of the time in our firm's experience, someone enters bankruptcy on their own petition, so on a debtor's petition in bankruptcy, and most of the time they become bankrupt at the very minute that their debtor's petition is handed over the counter in the federal court, and that time is literally noted, and they serve their 3 years as a bankrupt generally from that moment. Creditor's petition is a little different. It's a creditor pushing someone into bankruptcy. When a sequestration order is made, then the job of the trustee in bankruptcy is, apart from seizing assets, is to determine at what point did the bankrupt become insolvent. And that is the point at which the bankruptcy commences again for 3 years. And there are a range of look-back periods there. In our experience, we're less involved in that most of the time. That you can see a bankruptcy coming. It's generally planned in one form or another, and you're best to use a debtor's petition if there's no other alternative wherever possible. What is important to realise, though, is that trustee in bankruptcy can't take assets mortgaged to third parties. They can become the owner of the asset, so they can have the transfer of the real estate, for example, transferred into their name, but they can't override the rights of the mortgagee, provided that the mortgagee's security is properly registered and enforceable. And it's pretty rare that we've seen any significant tussle between a trustee in bankruptcy and a mortgagee, but it does happen. So it's safe to say, though, that if you can ensure that the right parties and the right entities hold security over the right assets, and even in a bankruptcy, as we've seen in Paul's paper for secure debt process, even in a bankruptcy, those assets can be adequately protected, taking into account the 4-year look-back periods and so on. So let's look at some of the solutions, and we've touched on both of these in Adrian and Paul's papers this morning. Helen has no joint assets in her name with Rick or anyone else. She's got it all in her name, main residence, units and shares in her company. We've looked at the usual solutions in transferring those assets away from her to a trust entity. Everyone's aware of the tax and stamp duty costs of that and the change in the nature of, for real estate anyway, treatment of land tax and main residence exemption for CGT purposes. Occasionally, a couple of times a year, we are asked questions by our Legal Resource Club members about, well, if I pay stamp duty on the transfer of this property, from my client who's in trouble to a wife or a trust or whatever, is that enough? And they're thinking that on the basis that, well, I'm paying stamp duty at full freight, so I should be protected. And that's not true. Stamp duty is not that relevant. What is relevant is, has there been a market value consideration paid for the asset? If there hasn't, then you're well and truly in the look-back area, and we'll go into that in a moment in terms of avoidable transactions, at which those transactions can be undone. So if we don't transfer an asset, what do we do? Well, first of all, we identify a safe place to place it, look at the transaction costs. If they're unacceptable, then harking back to Paul's first paper today, use our secured debt strategy to achieve a very high level of asset protection, but being conscious that it's not a silver bullet. There are some time limits, and in bankruptcy, we've talked about, well, when is the relation back period? When's the date at which the bankrupt became insolvent? That's the time to look at what the assets of that person were at that time. If that relation back period goes back prior to the date of the gift, then we're in trouble. There are some other rules, though, that allow the trustee in bankruptcy to go back further. In Section 120 of the Bankruptcy Act, and we've talked this morning about a 4-year look-back period where the person making the gift is solvent at the time of the gift. I'm not sure if it came out in the presentation this morning, but in implementing this type of strategy, we'll actually go through with the accountant and identify the equity as well as it can be identified, and by statutory declaration, the client will sign something that confirms they've looked at their assets and liabilities and they are solvent at that point. Apart from being good practice and part of due diligence from our perspective, it also is an attempt to limit the look-back period to that 4 years, not 5. Whether you want to go further and have a solvency report, as some people do, in quite a lot of detail, sometimes that's appropriate if there are a lot of related entities, but the principles are the same. What that does, though, is just leave open then in that 4-year look-back period any transactions that were done at less than market value or for no market value or consideration. And the other side, or the other way to look at this is that, well, leave aside whether they're undervalued transactions. If there was a purpose or a motivation in undertaking a transfer that was a motivation to defeat creditors, where the main purpose was to defeat creditors, it's not part foray and dominant purpose, main purpose was to defeat creditors, and if that property that was given away would have been available to the trustee in bankruptcy, then there's no time limit. There are also, I should say, similar provisions in each state legislation, in the property legislation in each state in Queensland, I think it's the Property Law Act, although Paul may correct me on that, Conveyancing Act, Paul, which has similar rules in it. So it's not just the Bankruptcy Act, but this is the area which most people look at first and foremost, and which is most used. We talk about having no time limit available to the trustee in bankruptcy when they're pursuing an earlier gift or transaction at less than market value, where they would say, and it's their onus to prove, that the main purpose was to defeat creditors. Well, it's got to be, first of all, which creditors? Well, it's got to be existing creditors versus future creditors. Which is it? It will operate in relation to existing creditors, so again, that solvency statement is important to work out, well, who are the creditors at any given moment when we're going to undertake one of these transactions. It doesn't include future creditors, unless those future creditors are contingent, and some of you will have heard of Cummins' case, a QC who did a pretty good job of transferring assets 15 years prior to his bankruptcy, but one of his problems was that he never put in any tax returns for a much longer period than that, and not unreasonably, the trustee in bankruptcy took the view that, well, you should know better, and lawyers shouldn't be ignorant of the law. There are plenty of ignorant lawyers, but they shouldn't be ignorant of the law, and you should have known that the tax office would have been a creditor had you put any tax returns in, and predictably that transaction was set aside under Section 121, but there aren't very many successful cases in that area because it's so hard to prove, because you have to prove purpose, and you have to prove evidence to show why that transfer happened, and on the other side, if the bankrupt or his beneficiaries can prove some other purpose, then it makes it a very difficult fight to win for the trustee in bankruptcy. In a case where that had happened and where the trustee's claim was defeated as one of Andrew and Florence, where there was a lot of evidence about the domestic purpose of granting some options to the wife prior to the husband's bankruptcy. Her evidence was very strong, and any of you who have been married for a long time will feel this, that we are easily persuaded when it comes to keeping home life happy and well adjusted in these sort of circumstances. And if the spouse puts pressure on in that way and it's legitimate and the real reason for transfers is that, then at least on the basis of the evidence in Andrew and Florence, that will be successful. So the detail that was not in Paul's paper this morning quite deliberately focused on the mechanics of how we do the secured debt process. That detail about the look-back periods and the ability for the trustee in bankruptcy to set aside those sort of gifts, and for that matter, those transfers that might be undervalued, principally in Section 120 and Section 121 of the Bankruptcy Act, and a heap of detail in the synopsis for you on that. So let's move to company asset protection and what that looks like. Adrian touched on this towards the end of his paper earlier today, where he was talking about using discretionary dividend shares to declare dividends or frank dividends from one company to another, and where there were unrealised capital gains, for example, in the company, could there be a gift of an amount of money representing those unrealised gains to a passive company, to a reserve company, and a loan back? And that's what we'll look at here. We won't go through the dividend and the tax issues with to be considered in dividend access or discretionary dividend shares. Let's look at a straight-out company-to-company gift. Now, for the same purpose, to shift value away from a risk area, in this case away from Helen Co to a reserve company, and have those funds loaned back with security to give protection to the Helen Co assets. Now, whether you call those assets goodwill or, in Adrian's example, drilling rigs or whatever it is, the mechanics are the same. What we need to look at, though, is the validity of the gift. Can a company actually make a gift? What are the statutory clawbacks under the Corporations Act? And what are some of the tax issues in the gift, as opposed to the dividend strategy which Adrian talked about earlier today. So can a company make a gift? Absolutely it can. The Corporations Act recognises that a company can undertake a transaction which is not in the interest of the company, so long as it obtains the consent of shareholders on the basis that directors have a fiduciary duty to the company and to the shareholders. And if it's the directors who are signing documents to make a gift on behalf of the company, then it makes sense that shareholders consent to that or not. But it would only be implemented with shareholder consent, which is not usually difficult in a family scenario. So the specific provisions are in Section 124 of the Corporations Act, which, subject to the director's fiduciary duty to shareholders, yes, a company can make a gift to another company. In fact, to anyone, but in this case to another company. So if we decide to do that, can that be set aside? And there are some statutory clawback provisions, and there's a number of them, what you might call voidable transactions, and It's four mainly. There are three sets of insolvent transactions which can be set aside, unfair preferences, and many of you would be familiar with that, dealing with clients who have gone into liquidation and claims by liquidators to claw back monies paid by the company, often to advisors and accountants as preference payments. Also uncommercial transactions with related entities while the company is insolvent, and transactions designed to defeat or defraud creditors. And the fourth clawback provision is in the director-related transactions, which we'll go through as well. That does not rely on insolvency of the company to be enlivened. So with insolvent transaction time periods with preferences and uncommercial transactions, for preferences we've got a 6-month look-back period where a creditor may have received a preference over other creditors, and that's a fertile area for dispute and reward for liquidators if they can show that if they can claw back some money paid to creditors in the 6 months leading up to appointment of liquidator. Uncommercial transactions are a little harder to succeed on, usually because by the time the company's gone under, quite often there's not much left anywhere. But even so, the look-back period there is in parallel broadly with the Bankruptcy Act at 4 years from the date of appointment of liquidator or the date upon which the company became insolvent. Now, with transactions to defeat or defraud creditors, there's a little bit more involved in that because gifts, in this example, gifts by their nature will almost always be uncommercial. And then the question is, well, whether the gift was an insolvent transaction and a solvency report or a solvency measures to determine that the company was solvent at the time it makes the gift takes away the powers of the liquidator in relation to these insolvent transaction clawback provisions, because the company was solvent, then this is not enlivened. But if the purpose was to defeat or defraud creditors, then the clawback period is longer, and again, it goes to purpose, and we've talked about that in relation to the Bankruptcy Act and similar onus of proof in this scenario. What is interesting, though, is the unreasonable director-related transaction clawback powers for the trustee in bankruptcy. It's limited to 4 years, and you would have thought that a transfer of an asset from one company to a related company would flat out be fit within Section 588 FDA, and that's not always the case. The criteria for who's a related party is quite strict. So it's a transaction between the company and a director or his or her associate or another person on behalf of a director or an associate. Now, associates are limited to individuals by the legislation. They're limited to directors and relatives of the directors and spouses of the directors. So on the face of it, a gift from one company to another does not fall within the four corners of that provision. Although having said that, it's fair to say a liquidator would have a crack at this if it were within the 4-year look-back period, so the sooner we do it, the better. And again, reminding ourselves that this provision is enlivened regardless of whether the company is solvent or not. But certainly doing a gift from the company to a person, an individual related to the directors would be a problem, less so if it's a reserve company in relation to Helen's example today. Reminding ourselves of what this all achieves, what we're trying to do is to provide a level of asset protection which is robust and enforceable without triggering the stamp duty, CGT costs and so on of transfer of assets. Whilst in this set of overheads there's not a lot of detail on this, there's a lot of detail in your synopsis on other tax aspects of the company-to-company gift, particularly in whether that gift could be treated as a dividend under the 1936 Tax Act, Section 45B, and the answer is no, it's not a dividend. It steps well outside of that. Also looking at whether Division 7A would apply. Well, most of you would know that transactions between private companies and particular payments and loans are protected by Section 109K. We don't have a transfer of an asset, so we don't have a CGT event that applies. So if you are minded to read the detail in the synopsis on that, there's plenty there to keep you busy on the tax side of things. The overall aim, of course, is to make sure that we put, in the case of an individual, bloodline trust for Helen, in a position as secured creditor over her personal assets, and in relation to Helen Co, to put Reserve Company in a position as a secured creditor over Helen Co, and protect the rights of our client in that fashion. Adrian, any questions?
Thanks, Brett. Just the one question. If a client has implemented the secure debt process, have you ever defended it, and does it work?
I'm assuming that's not a Dorothy Dixer.
Of course not.
Yeah, we have. At least a third of our fees here for some years now has been in litigation. That's not something we go and look for, but in fact, is a lawyer who can't fight like an ashtray on a motorbike, in my view. So, yes, we do a lot of it. And no, I can't think of any occasion where we've lost an asset where we've been able to implement this within or outside the look-back periods or outside the scope of actions to defraud creditors and so on. So yeah, we do it a lot, and it's not much fun, but it works. Yeah.
Thanks, Brett. That's the only question from this session. So I will introduce Paul back to the camera, who's going to tell us about succession planning for family business.
Thank you, Adrian. So yes, we're going to talk about succession planning for family business. This is an area that I actually particularly enjoy working in, working with family businesses in areas that we're not going to talk about today, where they might be selling the business to a third party. I do particularly enjoy that, but I also enjoy the transition from mum and dad predominantly to the next generation. We've done a lot of work for some large families, particularly one extended family in the north, some very large rural clients, and it is particularly enjoyable work to see that next generation take the business forward. So we're going to look at two different scenarios. Firstly, handing the keys to the kids. Then we're going to look at, I guess, a couple of different options within that. Are the kids paying for the business, or is it a straight handover? And how we might document that, or whether it's just a handshake deal. Here's the keys, and I know the kids will look after me. It does depend on the family, and generally most families that come into that first category have a strong idea of what they want. The second option we're going to talk about today is bringing the kids into ownership with you, whether that be a formal stake in the business or a more informal leadership role. So really the first step is identify the structure of the business. Are we in a trust, for example, discretionary trust or unit trust? Is the business in a company? Well, what are the shareholdings in that company? Are they owned by a trust, for example, or an individual? What are the directorships within that company, and how might it operate? So once we understand what the structure is, how we might transition that business to the next generation becomes a little more clear. Obviously, if we're working with a discretionary trust, it can be a lot easier to transition that business to the next generation. But no matter what the structure, one of the best ways may be a sale of the asset and utilising small business CGT concessions. The reason we say that is that, one, we get to lock in the use of those concessions now when we know what the rules are, and we might be able to put extra money into superannuation if that was something the clients wanted to do. I'm not going to go into that in this paper. Adrian will be talking about that in a later paper. But depending on the value of the business, we might be able to sell the business to a new structure, which is appropriately structured, and we might be able to give the kids a market value cost base without any cash payments being required. Obviously, if if mum and dad want to be paid for the business, well, that obviously can be accommodated. Obviously, no matter what the structure, if we're dealing with a company, for example, owned by individuals, or a business that's owned by an individual, it brings in more complex notions of how we might transition that business to the next generation. So the first one is probably the easiest. If the business is run by a discretionary trust and mum and dad are simply handing the keys to the kids and saying, it's yours, take it, we don't want to be paid, we might just change the principal or appointer of that trust to the children. We may need a change of trustee, or we may be able to reconstruct the company. And if there are multiple children involved, we may need some form of governance agreement. Often when we're handing the business to the new generation, they might not have the business savvy that the parents had as they built that business, and a governance agreement might be a valuable exercise for them to understand all the details of what the business involves, and really set out a framework for disputes more than most things. I'm going to talk later in the paper about the governance agreements in particular. So what if mum and dad want to be paid an amount? And they're operating again through a discretionary trust, where they're going to take those steps we said in the first, on the earlier slide, where they hand over control. So if mum and dad wanted to be paid an amount, may not be the full amount of the value of the business, but the business didn't have the money to accommodate that, what we might do is look at revaluing the assets of the trading trust and setting aside that value on the balance sheets in an asset revaluation reserve. What we do from there is we make a capital distribution of that amount to either a new trust for mum and dad, or even directly to mum and dad, although it has its own asset protection downside risks that we've talked about today, so a trust is probably more suitable. And then that new trust would lend that amount back to the trading trust, because we know that the trust in this scenario doesn't have the funds to support that payment yet. So the terms of the loan that we put in place between these two entities deals with how that amount is paid back. And generally we would say it's paid back probably principal only, without interest, although there can be interest paid. And we would pay it out over a certain period of time, giving the kids the ability to pay that amount back over time as the business profits. So that's a way we might help fund a transition to the next generation from a business in a trading discretionary trust. So what happens in circumstances where there's multiple kids? This is a scenario we often get asked, not necessarily in a trading situation where they want to hand the business over, but oftentimes there may be an asset of whatever nature where they want all of their children to benefit equally, but only two kids might be involved in that business. What we can look at doing is what's called a trust split, which is really a way of ensuring that all of the income and capital distributions from that trust go equally amongst the three branches of the family. Now, the Commissioner issued a tax determination last year, 2019-14, in which he set out two separate examples of where a trust split will cause a CGT event and where the trust split will not. There's been a lot of scrutiny by lots of commentators, including us, around the efficacy of that determination, and there's more detail about that in your paper. But effectively, the second example gives us a roadmap, so to speak, with which we can follow to ensure that we stick within the surrounds of that taxation determination. So if we stick as close as we can, and some of the features that the Commissioner says should be present so that there is not a CGT event, are that the expenses of the trust are met by all of, the three branches of the family, and effectively decisions about who the accountant might be. There is one set of tax returns, financials and the like. Those are some of the indicia that the Commissioner says will be possible without a CGT event. So a trust split is still a possibility to help clients in this scenario, but we just need to make sure that we exercise some care. So where we're looking at a company structure, if we've got a trust as a shareholder, the same steps I've just taken you through about handing over control or dealing with that trust split aspect are there. If obviously there are multiple shares, then we might even take some extra steps in relation to that trust split. Where it gets a little more difficult is where there's an individual shareholder. So if we look back at our scenario for Helen, she's the individual shareholder in her company. So we'd look obviously at the first step of using small business concessions. Now there's some extra rules that have been in a bit over a year now in relation to shares in companies. But in our circumstance, it's a trading company. All of the assets of the business are the only assets of the business, of the company, sorry. In that case, it's probably very likely that she would have access, subject to the other threshold tests, to those concessions. If that were possible, that's the best option we could take. Then, if that's not an option, we'll look at some alternative measures. So again, the first option: sell her shares. Use the discount capital gain and small business concessions. So earlier in the day, we talked about the value of the company being $2 million, and therefore the value of her shares being $2 million. So if we sold the shares to one or more discretionary trusts for $2 million, we'd have access to the discount capital gain, the small business 50 concession, and the retirement exemption, which would leave us with a zero taxable income from that transaction. Now, that's a very simplistic way to look at it, and it's never that simple in practice. There's always some deviations, but you get the idea that we should be able to, depending on the purchase price, or the value, I should say, of the company, to deal with that $2 million gain without any CGT payable. Now, depending on her age, Helen might not have to put that $500,000 into superannuation, or if the kids were paying an amount, it may be that they're only going to pay $500, and she may decide to put that money into superannuation. So this is a scenario which can be utilised in different ways, whether the kids are paying or not. So we might set up one or more bloodline trusts to acquire the shares in the company. They would use a bearer note, which we talked about earlier, which is a form of cheque, and they would pay her for the shares, thereby obtaining a market value cost base. She would utilise the small business CGT concessions to either eliminate or significantly reduce the capital gains tax payable, and depending on whether she is being paid for her shares or not, she'd either make a loan back to those trusts or make a gift to those trusts. So what we've been able to do is transfer the shares, utilise the small business concessions, and give the kids a market value cost base for their shares. So a sale option may not always be available. It may be that her other assets are push her over the $6 million maximum net asset test. So what options can we choose? Well, Brett talked about our contractual will. Helen might put in place a contract that she leaves those shares in her will to those two bloodline trusts that we established. And what what that does is it guarantees the kids that under the will, they will get those shares through their bloodline trusts. But what does that do for the company now? What is left in the company is, well, who are the directors, who are the shareholders, and who effectively has the control over that company. So Helen might retire as a director or resign as a director and appoint the kids. But in that case, Helen still retains control over the company because she's the sole shareholder until she dies. So what we might do is set up a position where she grants an irrevocable proxy or an irrevocable power of attorney in relation to her rights in relation to those shares. So she might give the kids proxies over any voting rights she has in the company. The one issue there is that the company can't really pay a dividend because that dividend will have to go to Helen. So in circumstances where the main source of income to the owners is through dividends, this structure may not be the best, but we're trying to solve multiple problems here. We're trying to pass control in a circumstance where we don't want to actually transfer those assets. There are some other options we could take in those circumstances. We could use an asset rollover trust, which was briefly mentioned earlier, which we're not talking about in detail today, which might grant the ability to distribute those dividends to a broader range of beneficiaries without there being a CGT event on the transfer of those shares to the asset rollover trust. Obviously, if that's something you want to discuss, we can talk about that at another time. The final step is in our contractual will process is an option granted over those shares in favour of the bloodline trusts, and that gives those trusts the guarantee that they will obtain those shares no matter what happens. So if we often call it a last line of defence. So if there was an attack on Helen's estate, the Bloodline Trust could exercise that option and acquire the shares. So obviously the considerations we take into account in this whole aspect is, well, what are the terms that mum and dad and the kids have come to in relation to handing over the business? Is there an agreement in relation to money being paid, and what are the payment terms? Again, that will the income to the business owners be dividend income? If it is, well, then we need to restructure those shares. We might consider whether guarantees have been given by Helen in this case, and whether Helen might take a security over the shares in order to guarantee that she gets paid the amount that they've agreed upon. So the second part of the paper is talking about working with the kids. How do we bring the kids in the best way possible? This paper really could be broadened to bringing in any new owner. And in fact, we've given papers of similar nature in the past in relation to bringing in new owners into your business. I think bringing in the kids has a different dynamic to it because there can be more emotion involved with working with your family members, and some of the barriers that you might have in dealing with business partners who are not related are broken down. So it's important to have a good structural framework for governance of the company or the trust. So the structural issues in terms of bringing in the kids remain the same. If we've got a company with a trust, well, we might bring them into a co-principal position or a co-trustee position, so that they have some form of effective control over their destiny in the ownership of that company. If the shares are in Helen's name only, well, again, the same structural issues apply, and we'd look at dealing with perhaps some of the shares, therefore reducing any capital gains tax. We might only just transfer a 25% interest in shares, for example. But again, it's about that governance framework going forward. So we always recommend with any business where there are, multiple owners, whether they be from the same family or independent, a governance agreement is a must. It gives protection to the owners. The owners have certainty about what the framework of their business is going to be. It gives certainty to KPIs that the business might have in relation to dividends, for example, or even where employees might come up and become an owner. Well, the KPIs might be built in to determine a level of dividend paid to them. Confirms the management structure and how that management structure might sit. It may be that you're bringing in the kids at a particular time where you don't want them to be in a management position because they might be a little bit young, but at a particular time they would have a position of management on management of the company. The other one to deal with is exit events. And oftentimes when we're dealing with family succession, where mum or dad might hand over the business to their children, multiple, they recognise that all of their kids may not want to stay in the business the whole time, or they recognise that two of their kids get on really well and the third one is a constant, there's a constant battle, there's friction there. But being parents, they want their children to benefit equally from the business that they've built. So it's important to put in place, well, what are those exit events? How do we exit one party, and what's the mechanism for payment in most circumstances? So how do we do this type of work? Well, the first step is information gathering, meeting with the clients, understanding their needs, understanding what the needs of the broader family are, meaning their children, whether they want to work in the business, whether they don't and they merely want to be the recipient of dividends, attend the odd shareholders meeting, but gather as much information as we can, and then we put that into a draft agreement. Then we send out the draft agreement and we meet to review it and talk through the issues, and there are many. The family we helped up north that I referenced earlier, I think we met with them over the period of 18 months, probably about 8 times, and that was 8 times with 12 people in the room, and then we had multiple meetings one-on-one. So in those circumstances where you're talking about very large family businesses, it's important that everyone gets to have their say and understand the mechanisms of that final agreement. And obviously then we get to the final agreement, we meet, we review it, and we sign it. So the elements of our governance agreements that we put together for clients, it deals with the orderly conduct of the company or the business. Deals with directors' appointments, and we're talking about companies and things like that, because most businesses will have a corporate trustee in these circumstances, even if they're a discretionary trust or a unit trust. So we still need to talk about what the directors' appointments of that trustee company are. Valuation is important, how a business might be valued. Different industries deal with this differently. I know engineers, I'm dealing with some engineers at the moment about their valuation, and they are all about multiples. The multiple of, this calculation is the business value. Whereas my farmers, for example, they will often defer that decision or refer that decision to a valuer or even their accountant, for example. So it really depends on the business you're in or who you feel comfortable making those decisions. But valuation is important, particularly when it comes to an event for sale. What are major decisions and what are the voting thresholds on those major decisions, and who gets to vote? Is it a shareholder vote or is it a director vote? What are the trigger events for a sale of shares? How do we fund a buy-sell arrangement? and what are our dispute resolution mechanisms. So they are the mechanisms or elements that go to making up a robust governance agreement. So we've listed here a few events which trigger a sale notice. So a sale notice can be given by a shareholder, for example, to the other shareholders, and a sale notice basically says, I want to sell my shares. But there are other events which are deemed sale notices. So if a person dies, that may be a trigger that their shares are up for sale to the other shareholders. Often that is the case because in a non-family setting, you may not want to run your business with the widow of your former business partner. So it may be that at that time, if they pass away, you can acquire their shares. In insolvency of a shareholder, that will be a trigger for sale so that you don't end up running this business or at least having a shareholder who is a trustee in bankruptcy. A company director is dismissed for cause, stealing from the company. Well, that may be a trigger that they have to sell their shares. A loss of control of a company shareholder, so if they transfer the shares in the shareholder company, effectively what they've done is they've sold their interest in the company. Change of trustee without consent. And one I've got at the bottom there which says the family court ? The reason it's a question mark is that it's a question that we put to clients. Well, if your business partner or your brother in this case goes through a family court dispute, do you want that to be a trigger for the sale of their shares? Some people do, some people don't. The reason I guess it's there as a option is that the family court proceedings can be a bit disruptive for your business. With information requests from lawyers in relation to valuations and the like. It may be simpler that person is effectively bought out. It can be a bit harsh on the person who's going through a family dispute, but that obviously is an agreement that you agree before you sign this document. Major decisions are really important. Working out, well, what are the decisions that are termed major decisions and therefore generally require a higher threshold of voting. So the decisions we have center on these things: fundamentally changing the business, selling the business or acquiring major assets or borrowing money over a certain dollar value. They're all major decisions of a business, and if we're entering to a governance agreement, we might decide that those decisions require a majority of shareholders to agree. Or it may be that some of those or all of those require unanimous consent of the shareholders. They're the things that we need to determine talking with our clients. So we're going to look at two case studies, and they're, believe it or not, one is which it was done well, one wasn't necessarily done so well. So in this case, the case study, and they're both real case studies from clients. If they're your client, you may recognise them on the screen. Obviously, we won't name them, but they are clients. The first one was a drilling business. It had an initial value of $900,000. There was a transfer of 30% to a key employee as a gift. That gift aspect is something we get a lot. I want to reward my key employees by giving them some equity. I don't expect them to pay. That happens quite a bit. Obviously, there is a taxing event, no matter whether we gift it or not, because the market value substitution will apply. But in this case, we utilise small business concessions to get rid of that gain. Obviously, we probably used up some of our retirement exemption on that, but we didn't put in place a governance agreement. So 3 years later, this business had undergone rapid growth, was valued at that time at about $4.5 million. The key employee became disgruntled and commenced a competing business on the side and started stealing clients. Ultimately, that led to his sacking. and he then demanded 30% of the value because he owned 30% of the shares in the company. So he demanded $1.35 million for his shares, and not long after that, obviously a dispute arose, but he took the company to court in relation to a minority shareholder oppression suit. And one of the remedies available in an oppression suit is a wind-up of the company. So in those circumstances, on a wind-up, he might stand to acquire probably not 1.35, but somewhere thereabouts. So the outcome of this was that the court action settled for $1 million, but he didn't pay anything for his shares. So unfortunately for our client, they cashed out $1 million from their super to fund that transaction. Going forward, there was further disruption in that industry, which caused a collapse of his business, and he was pursued in relation to his ongoing guarantees that he had given. But the Bandit had not provided any guarantees. So you can see in that circumstance, purely the lack of a governance agreement was a major undoing for our client. The second case study is where we do it properly. A successful business owner with one owner introduced two employees at 15% each, and the shares were partly paid. They put in place a shareholders agreement, which basically said, well, within the first 3 years, if you leave, you only get what you've paid up on your shares. So they were partly paid. You only get your paid up amount, not market value. The majority had the ability to exercise an option on those shares in that time, and they had a dividend policy and a restraint clause. Obviously, fast forward and there's a dispute about dividends, even though there's a policy in place. The disgruntled 15% owner resigned and commenced a similar business in competition. Our company was able to reacquire those shares for nil because they were partly paid, and the restraint was then enforced. So look, you can see the difference between those two, glaringly obvious. I would love to say they're made up. They aren't. They are built on cases that we've acted for clients. But there are lots of different options when trying to pass the business to the next generation. Having in place a suitable framework that the next generation can provide significant benefits in establishing that decision-making and dispute resolution framework. As I said, lots of different options, but we recommend if you're going to bring in a new owner, whether it be the kids, we make sure we get that governance agreement in place. So I'll hand over to the moderator, which I think is Brett, with any questions.
Thanks, Paul. We have, excuse me, only one question that's come up that not necessarily related to your paper, I think, but it talks about, asked the question about if we change trustees of a trust or principal of a trust or appointer of a trust, does that have any other tax implications? The answer is generally no. Always with the caveat, read the trust deed and look at the rights of beneficiaries and whether changing those things changes the rights of beneficiaries, which of itself may be a CGT asset for those people, but generally no. Having said that, it is important to do those documents very carefully and strictly in accordance with the trust deed. So that's the only question I've got in front of me at the moment. Well, I think we're due for a break. It'll be the last break of the day, and then we have another 2 papers to finish this afternoon. And I'd like to break now for just 5 minutes till 3:55. So we'll hand back to our hosts, and you guys can get a brew or a drink or whatever, and we'll see you back here in a few minutes.
Good afternoon, everybody, and to the presentation. Good afternoon again, sorry everybody, and welcome back to the presentation. I hope you enjoyed that very short break. Just a question that came in during the break, how important is the role of a pointer in a trust? Very important is the short answer. That's really where the control is within the trust. So certainly if I'm picking up a trust deed to have a look at it, that's one of the roles that I'll quickly look at. One of the first ones to have a look at to see who actually controls the trust. Because if I am the appointer, then I can usually change trustees. So yeah, very, very important role. And we need to really think about who's fulfilling that role when we're establishing trusts or bearing trusts. Next paper I'm going to talk about is in relation to small business CGT concessions and having a look at whether there's any opportunity due to COVID-19. We always like to look at the COVID-19 positives, whether there's ever any opportunity that we could use them, and principally having a look at if there's a reduction in value because of obviously business interruption or property reduction, so that we could have a look at clients that potentially may not have previously qualified, now qualifying for the small business CGT concessions. Part of the paper will also cover the changes that came through that Paul mentioned briefly before that were announced in the 2017-18 budget in relation to changes to the small business CGT concessions, in particular in relation to changes to shares and units and qualifying for the concessions there. So they were announced 17-18 budget. They are in effect. Initially, they were going to be, I guess you'd call backdated. However, they were later changed to be effective from the 8th of February 2018. So we've got two bodies of law there. We've got using the concessions before February 2018 and using them after if we're selling shares or units. So to cover off on those changes so that everyone's abreast of them, we've got some new concepts. We've got the idea of the object entity. So we have a look at what's called the object entity if we're selling shares or units. There's a stricter active asset test. There's a further qualification that if we're relying on the $2 million turnover test, so the small business entity test, they must also be a small business. So with that, you may recall, or you should recall, that there's two alternative tests that we rely on, either the small business entity test, the turnover test, or the maximum net asset value test. If we're relying on the maximum net asset value test, the object entity must satisfy the modified $6 million test or the modified small business entity test. So with that, I will go through an example later on to flesh these changes out. But obviously we need to be aware that we need to look at the value of the entity itself. And there's also some further changes in relation to thresholds and percentages. Current test, or what previously, in terms of what the test was, in order to be currently, in order to be an active asset, it has to be owned by the taxpayer and used or held ready for use by the taxpayer, its affiliates, or its connected entities. It must be at least 7.5 years if it's been owned for 15 years or longer, or at least half of its ownership period. So that's the active asset test. Applying those to shares, because the shares themselves aren't held ready for use in a business, there are the extensions that say under our former tests, so former legislation pre-February 2018, it'll be active where the total market value of the active assets, marketable securities and cash is more than 80% of the market value of all of the assets of the company or trust that we're selling our shares or units in. So that's changed slightly now, and we still apply that 80% test, but there is now a requirement that 80% of the assets must be active assets, and it does exclude shares in other entities and financial instruments or cash that were obtained in order to pass the test. And there's also a look-through approach for shares or units owned by the object entity. So having a look at that look-through approach, one of the new requirements is that the object entity must also be either a CGT small business entity, so that's that 2 million test and operating business, or satisfy a modified maximum net asset value test. The main modification is that in order to be connected to another entity, it's usually the case that we have to hold 40% of the shares or units. If I hold 40% of the interest in the Cleary Hall Practice Trust, then that Cleary Hall Practice Trust is connected to me, and I need to take the whole value of that if I'm disposing of my units. Of course, our practice trust has no value, so not so much an issue for us. However, that's now changed, and we've now got a 20% test when we're selling shares or units. So if, for example, previously we had a company that held 30% of the shares in another company, and we sold our underlying shares, under the old test, we wouldn't have to take the whole value of that other company into consideration because we only held 30%. Under the new test, we would have to. So what we're going to find is that when we work through ownership and we work through the rules and the new rules when we're selling shares or units, we may find that some taxpayers who are eligible under the old rules may no longer be. These are getting more and more complicated rather than less complicated. So there's going to be increased compliance costs and, of course, a greater chance of making a mistake in determining eligibility. And I can tell you that the tax office, in terms of reviews of small business concessions, certainly something they go through with a fine-tooth comb because they are, to be honest, they are quite generous. So with that, there's further compliance in terms of accessing the small business concessions. So if we are selling shares or units, we need to be aware that the changes are in, they've been in for a little while, and they do impact on us. So we do have to revisit them, of course. We should revisit them every time we're looking to give advice to clients on small business concessions, but particularly if we're looking to sell shares or assets. So I said we'll flesh that out a little bit in a case study, and we're going to use the family group that we've been using for this presentation. So Rick and Helen, if you've joined late or just as a bit of a refresher, we've got Rick and Helen who've been married for 29 years, Charles and Caroline, daughters from first relationship with Helen. In terms of assets, originally, so going back to our original case study, she's got her real estate business of which she is the sole shareholder. That value of that business is $6 million. Home on the waterfront, $2 million. Unit in town, $1 million. Straight away, we can see that there's going to be issues with Helen and the small business concessions. We're on the assumption that her turnover is more than $2 million, and if she's got a real estate business with a rent roll, it's very likely to be. Then she's going to struggle for the small business, for the maximum net asset value test, because she's already at that $6 million threshold in terms of Helen Co. And of course, we'll need to think about what other assets need to be taken into account. So we'll work through those provisions to have a look at that. She's also got super, remembering, $450,000. So of course, the question is, do we have to include super? Now, a variation to this. As I said, we're going to have a look at if there's an opportunity to restructure Helen now because there has been a drop in value. So in our hypothetical scenario, Helen's rent roll has fallen through the roof, through the floor, I should say. Normally it goes through the roof, particularly living in Sydney. However, no one's paying rent. There's issues in terms of you can't evict clients. Her business is suffering, and really the value of her business as we stand today is not $6 million. It's $3.5 million. We've also had a reduction in value in property, and in particular, the unit in town has dropped to $100,000 off its value. So previously it was $1 million, now it's $900,000. So thinking about our small business concessions, can Helen restructure or sell now tax effectively? So let's work through the concessions. We're going to do it on the basis of our new COVID-19 figures to see that if we meet the tests, and when we meet the tests, what is the best outcome for Helen? So having a look at it on the basis of, look, Helen's had enough, she just wants to sell and realise assets in terms of the business. She doesn't want to restart it when the economy restarts. She's had enough. Or alternatively, could we sell now in a tax-effective way to a new structure and then also obviously have the benefit of a new cost base in our new entity, as well as using the concessions that we wouldn't have qualified for before. So in terms of a recap of the legislation, what we're going to have a look at are the basic conditions in 152A, and then touch on the four main small business CGT concessions. Not going to spend much time on the 15-year rule, but have a look at the small business 50% reduction, retirement exemption, not going to dwell on the rollover in 152E. So our basic conditions. So in terms of meeting those, we have to meet one of the following. Either we are a small business entity, or we satisfy the maximum net asset value test, or a partner in a partnership that is a small business entity and it's a partnership asset, and that it's an active asset. So thinking about Helen's situation and Helen Co., we're either going to sell the assets out of the company, so they are going to be active assets. As Helen holds 100% of the shares, it's going to be connected to her. So we need to take in the whole value of Helen Co. That's okay. That's $3.5 million these days rather than $6 million. If we're selling the shares, then remembering those new conditions, we're either going to have Helen Co. meet the maximum net asset value test in its own right, because it's the object entity, again, $3.5 million, so that's okay. Or Helen Co. would need to meet the turnover test, which it isn't. So either way, in that scenario, we of course need to think of both scenarios and have a look at what the conditions are and whether Helen meets them. In terms of the maximum net asset value test, the things that we need to take into account are the net value of the CGT assets of the taxpayer. So returning to our example, it's going to depend on whether we're selling the assets or the shares. If we're selling the assets, the taxpayer is Helen Co. If we're selling the shares, it's Helen. The net value of the CGT assets of any entities connected with the taxpayer, and the net value of CGT assets of affiliates. So initially, that's a broad scope, but of course, there are some things that are ruled out in terms of net value in assets that we need to consider. One query might be, well, what actually is net value? What does that mean? So that's provided for us within the legislation. And it says the net value is the sum of the market values of the CGT assets less the sum of liabilities of that entity that are related to the assets. Equity interest in a connected entity of the first entity or an affiliate of the first entity are disregarded, remembering that we've got those modifications now for selling shares. I mean, what that means in practice is there are some things that are liabilities that may not turn up on our books, which we can take into account. An example of that may be if we're selling a building subject to a lease. In terms of the lease payments or the obligations under the lease, that's a liability. So we may be able to take in the value of those obligations at the time in terms of net asset value. So worthwhile considering other things rather than just simple assets minus debt, because there may be things not on our balance sheet we can take into account. Other things provided for in the legislation are things like long service leave obligations and other staff employee obligations or potential liabilities. If we're looking at individually held assets, following are disregarded, assets being used solely for the personal use and enjoyment of the individual, ownership interests in the individual's dwelling, super fund, policies of insurance. So if I quickly flick back to Helen's assets, shares in Helen Co. included, home on the waterfront, that's her PPR, excluded, unit in town, on the assumption that she's renting it out, that's included, self-managed super excluded. So in terms of value, we need to take into account 3.5 being Helen Co. and 900,000 being the unit in town. Assuming there's no liabilities, that gets us to 4.4 million. So we're well below the $6 million cap. I mentioned control of companies. Helen Co. will be related, or will be connected, I should say, to Helen, as she holds more than 40% of the shares. That's provided for in section 328125. So she needs to take into the whole value of Helen Co. So that's why we're taking into the whole 3.5 million as the current value. Turning to the requirements to use the concessions. So the small business 50% reduction. What we need to do is meet the basic conditions. So that's all we need in order to reduce the gain by 50% under the small business 50% reduction. One thing to remember, we can choose not to apply it. We can also choose the order in which we apply the different concessions. Bearing in mind, however, that if we qualify for the 15-year rule, that is something that has to be applied and we can't cherry pick them. We have to apply the 15-year rule. But in our example, we're saying that Helen doesn't meet the 15-year rule. So small business 50% reduction. She meets the basic conditions. What are those again? Active asset, yep. Selling our business assets or shares in Helen Co. and then also that she's either meets the maximum net asset value test or the turnover test. We know she meets the maximum net asset value test, so she will be able to apply the small business 50% reduction. In terms of the small business retirement exemption, which is the other exemption that we will look to utilise, or the other concession that we'll look to utilise, that's contained in subdivision 152D. Again, we need to meet the basic conditions, which we will. If we're under the age of 55, either contribute an amount to superannuation either at the later of making the choice or receiving proceeds. Considering Rick and Helen have been together for 29 years and it's a second relationship, I would suspect that Helen may be over the age of 55. However, if she's under, then we need to obviously contribute that amount to superannuation on that later of, so either making the choice or receiving the proceeds. If she's over the age of 55, then she doesn't need to make that contribution to superannuation. If our taxpayer that's making the game is a company or trust, then we need to have a CGT concession stakeholder. Helen is going to be a CGT concession stakeholder because she holds 100% of the shares in Helen Co. So we're going to meet that requirement for the small business retirement exemption. So turning now to what if there is a sale under our new COVID-19 figures. And what we're going to have a look at are rough tax figures. I say rough because I've done rough calculations. I haven't gone down to the last cent in terms of things like top-up tax and those sorts of things. And then also having a look at a share sale and having a look at the differences between the two. Because one of the questions that Helen may ask us if she decides to sell is, should I sell the assets of the business or should I sell the shares? And there's some fairly substantial tax differences which we'll see depending on which road that we go down. So it's always worthwhile doing that calculation. And then also as well thinking about, well, if we're doing a internal restructure, so we're restructuring Helen to something else, is it better to sell the assets or shares, and what's the tax outcome of doing so? So if we have a business sale, we receive $3.5 million for the assets of the business. So that will be received by Helen Co. Now Helen Co, as we said, meets the requirements of the small business 50%, so we can reduce that gain to $1.75 million. Small business retirement exemption, on the assumption that Helen hasn't used that elsewhere, we can reduce that by another $500,000. As that money is going to a company, we can pay it out to either Helen or her super fund. We can only pay it out to her, obviously, if she's over the age of 55, which leaves us with a gain of $1.25 million in the company, which tax at the 30% tax rate. All the rough calculations here are at 30%. Leaves us with tax of $375,000 in the company. Of course, that's not the end of the matter. And Helen's going to have a company with a whack of cash that's sitting in it. So what's left in Helen Co? In terms of the cash that's left in Helen Co, we've got $1.75 million, which is what we call untaxed. That's the amount that we reduced by the small business 50%. So that second line on this slide here, $1.75 million. We haven't paid tax on that. That amount's sitting there in our company. The balance is the retained profits after we pay our tax. So our $1.25 million that we paid $375,000, so $1.25 million that we paid $375,000 tax on, leaves us with retained profits of $875,000. If we took all of that out in one go, I know the idea would be to try and leave it in there and drip feed it, but for the purpose of this example, we're saying Helen wants to get her hands on the cash. She's no longer got a business, so she needs the money. The tax on the untaxed component, so the $1.75 million would be $725,000 in roundabout figures. So including top-up tax, further on our dividend of our retained profits of $875,000, our further tax to be paid, if we take the cash out of the company, is around $1.1 million. So out of our $3.5 million that Helen received for the sale of the business, she gets in her hot little hands a little over $2 million. So not a bad result, but we can do better. How can we do better? Well, we could sell the shares. And one of the reasons that we can do better is because if we're selling the shares, Helen's receiving the cash in her own hands. So we don't have that then subsequent requirement to have a dividend or take the money out of another entity. So the effect of that is what's tax-free to the company is not tax-free on a dividend. So the other thing that we all need to remember is that as Helen holds the shares individually, she will qualify for the discount capital gain. So if an individual or trust holds the shares for more than 1 year, or holds an asset for more than 1 year, in this case the shares, then we can reduce it by 50%. So if we have a look at the sale of the shares now, Helen sells the shares for $3.5 million. That's still the same. Assuming the shares have a nil cost base, that's a gain of $3.5 million. We apply the discount capital gain in Division 115, which reduces it to $1.75 million. Helen qualifies for the small business 50%, small business concessions. So she's selling shares. In order for them to be active assets, 80% or more of the assets of Helen Co have to be active, which they are. And she has to be a CGT concession stakeholder, which she is. And Helen Co needs to meet the object entity test, which it does, because its net value is $3.5 million. That reduces our gain in Helen's hand to $875,000. Again, applying small business retirement exemption of $500,000. If Helen is over 55, she doesn't have to pay it into super. If she is, she does. That reduces it by a further $375,000. Top marginal tax rate of 49% as an example. That leaves Helen with tax on the sale of $183,750. So that's all the tax that she will pay, and she gets to keep the rest of the cash, bearing in mind, of course, perhaps we have a requirement to put $500,000 into super, or maybe she wants to do that anyway to increase her super balance. But if we have a look at the comparison between the two, on a business sale, tax to be paid is roughly $1.475 million, so we're left over with a little over $2 million in cash. On a share sale, we're only paying $183,000, so our cash left in Helen's hand is $3.3 million, roughly. So a $1.3 million difference. Helen will be a happy client if we outline to her and we show her that she'll want to convince the seller to buy the shares in the company rather than buying the assets of the company themselves. As a lawyer advising a buyer, the advice would generally be don't buy the shares, buy the assets. However, if we could convince them to buy the shares, there's a substantial saving there. So if Helen wanted to sell now, because she's had enough of the business and had enough of COVID, then she could do so, and obviously that would be our tax result, thanks to the depression in the values. The other thing that we might think about is restructuring the assets. Probably not going to be tax effective or cost effective to take the assets out of Helen Co, because we're going to be paying too much tax. However, what we might consider is selling the shares to a trust or to a company. I recognise that there will be tax to be paid on that, on the $183,000, but it will put us in the position where we could sell the shares and move forward with a new structure in terms of having that trust holding the shares in Helen Co and allowing us in the future, if we do sell, to be operating off a higher cost base. If, for example, the value rebounds and Helen doesn't have any chances of meeting the small business concessions in the future. In terms of what we've just been through, it is complex and difficult legislation. I can tell you every time we write advice on small business concessions, we go back to the provisions and we reread them. And I can tell you each time you pick up different things. And sometimes you're not quite right. It's quite the rabbit warren you can go down. So if we do have issues with clients and small business concessions, we would suggest that they seek advice in relation to it. The different variations and the continuing of that in terms of the changes to sale of shares or units can lead to confusion, particularly if we're selling shares or units now with the new rules. And one thing to remember, do we have an opportunity now? So for clients that were either just over or close to the $6 million cap, for example, has COVID-19 economically impacted on them enough that we may be able to restructure tax effectively now using these concessions? So something worthwhile to revisit because it's a hard cutoff. If we don't meet the 6 million test or the 2 million turnover, that's it. We don't get any of those concessions. So if we have the opportunity now to use them, now may be the time to use them. I'm going to throw to Paul, who's going to moderate questions, hopefully.
Thanks, Adrian. I've got a couple of questions in. First question is, can't you do both, sell the shares and the business, have access to the CGT concessions twice?
You could, remembering that you only have a lifetime limit of 500,000 for the small business retirement exemption. So if we have used that up on one of those transactions, we won't be able to use it up again. But yeah, potentially you could do both. It comes down to the numbers, of course.
And the other question at this point is, for the retirement exemption, if Helen is over 55 and she wants to put money into super, can she choose to only contribute, say, 300,000, or does she have to contribute 500?
She has to contribute the amount that the election applies to. So if our gain is 500,000 that we're applying it to, she has to contribute 500,000. She can't contribute a lesser amount. Of course, if she's over 55, there may be an opportunity there if she's in pension phase to contribute the 500,000 and take some back out if she doesn't want to put it all in there. Going to depend on the circumstances, of course. It's also worthwhile remembering that that 500,000 isn't caught by any of our $1.6 million cap, so it could still go in even if she was at 1.6 million.
In that circumstance, Adrian, you could obviously reduce the amount of the election to that 300,000, but you'd obviously pay tax on the 200.
Yeah, or you could, and there's a couple of different varieties. You could, a couple of different options in terms of if you reorder some of the use of the concessions, quite often you could get to a figure that you want to put in. Yeah, it's a case of sitting down and working through the numbers most times.
Okay, well, that's all the questions we have, and we'll move on to the last paper.
Thanks, Paul.
So thank you, everyone. I was doing a little bit of a look through the list, and most people are still on the line for the last paper of the day, and I do appreciate that, having to present the last paper of the day. I know it's hard to sit around at 4:30 listening to Division 7A, but we'll try to get through it and get you out of here by the right time. So we know that changes to Division 7A have been flagged over a number of years now, with last year's budget effectively delaying the start again. It was scheduled to start as at 1 July 2020, but they did foreshadow further consultation, and obviously no draft legislation has been released at this point. Our view is that, you know, given COVID-19 and the fact that we've seen nothing in relation to this, that the changes will be delayed again, although that is just our best estimate at this point. I note that the Tax Institute of Australia yesterday put out a release asking or advocating for a delay until 1 July 2022 to allow, you know, for COVID-19 and the effects of that to be done, and allow proper consultation on the changes. But we'll see what comes in that space. So what do we know about the changes? So this paper is not really about what those changes are. They have to some degree been spoken about ad nauseum here and elsewhere. But broadly, we know that one of the main areas is UPEs to private companies will be clarified to be loans. They'll be Division 7A loans and confirmed within the legislation. There will be some simplified Division 7A rules in terms of timings and interest rates. They will be 10-year loans, and the interest rate will be a different interest rate to the one that is currently calculated. And there is a difference of about 3 or 4% between those. Higher, obviously, we don't choose the lower rate, but it will be about 3 or 4% higher than what we're currently paying presently on Division 7A loans. They are going to remove the concept of distributable surplus, which they see as there have been, you know, not so much schemes, but taxpayers who might have not had distributable surplus in an earlier year, and they might have made a loan to a shareholder, and then a later forgiveness of that loan is not taxable because there was no distributable surplus in that earlier year. So they're also going to bring in a self-correction mechanism to allow taxpayers who have inadvertently made mistakes. It seems to be broadly in line with, or the thought of it is broadly in line with the Commissioner's discretion at the moment, but it will be legislated. There will be some safe harbour rules in relation to where you might use an asset of a company and say, for example, there was a house purchased in a company and a shareholder used that house. Well, if you pay certain rent according to the safe harbour rules, then you would be within those safe harbour rules. They are extending the period of review to a period of 14 years, which is quite extraordinary. So effectively, you might make a payment or loan in this year. Well, you've got to perhaps answer for that in 13 years' time, and the effect that will have on selling companies. As Adrian said, you might sell shares. Well, the warranties and indemnities, that consequence of that period of review extension will probably have a limiting effect on the ability to sell shares going forward. And what they've called technical amendments to provide certainty, whatever that is. Obviously, the devil will be in the detail with all this legislation, and we'll wait and see when it's going to come out. We're going to talk about two different concepts today. Clients who want to change their structure to get away from Division 7A being a constant bane of their existence. Every year they meet with you, they operate in a discretionary trust, and they don't understand what these Division 7A loans are. Well, how do we get them out of the structure they're in? And we're going to talk about a rollover and obviously a sale to a new entity. The other part of the paper, we'll talk about those clients who don't want to restructure. Well, what options are there for them to deal with UPEs and Division 7A compliance? So there's two different rollovers available that we're going to talk about today, Subdivision 122A and Subdivision 328G. So firstly, Subdivision 122A rollover is where we might transfer all of the business or the CGT assets of a business from a trust to a company in consideration of the company issuing shares in itself to the transferor. So you can see from the diagram there, the CGT assets are moved from the transferor trust and the company issues shares to the transferor trust. The requirements of that rollover are that there must be a disposal of all of the assets of the business to a wholly owned company. The only thing you can receive in relation to that transfer is shares in the company. They must be non-redeemable shares, and the market value of the assets must be broadly equivalent to the market value of the shares that you own after the transfer. You must be the sole owner of the shares in the company after the transfer, and the trust must be a resident trust. So in short, you usually do these rollovers where you start a brand new company which is owned by the trust which owns the business, and you transfer all of the assets of the business to that company. And you don't have to, but you then can issue shares in exchange for the transfer of assets. The other option is utilising a rollover under Subdivision 328G. This has been in a number of years now. It was brought in at a time where it was heralded as a small business rollover, which would, I won't say revolutionise is a little bit strong, but it was heralded as something really good for small business to be able to help them restructure. As we got into the detail, we recognised that there were significant deficiencies, and what you thought might be possible wasn't really possible when you got into the detail. But these are broadly the requirements. That the restructure must be a genuine restructure of an ongoing business. There's a ruling which outlines some circumstances in which there will be a genuine restructure. Each party to the transaction must be a small business entity. There must be the same underlying economic ownership, which is one of the areas that brings into play some of the deficiencies is the terming around that underlying economic ownership. The asset must be an active asset, so you can't transfer passive assets, you can't transfer shares, you can't transfer investment properties held in a particular, whether it be a trust or a company. Both parties must be residents, and both parties must choose the rollover. So what is a genuine restructure? Well, there is a safe harbour rule which outlines what a genuine restructure is. And it says that in the 3 years following the transaction, there must be no change in the ultimate economic owner. There must be no significant assets the significant assets must continue to be active assets, and the assets must not be used for private purposes. The reason for this is you can go from a company structure owned in a particular way to a discretionary trust, for example, in which case, if you owned a particular asset in that first structure, you wouldn't be able to use a recreational asset for private purposes without complying with Division 7A. And what they're trying to align that to is where you transfer it to a discretionary trust, they don't want you to then be able to use those assets for private purposes. So there is an opportunity using the 328G rollover to deal with the existing UPEs. And the opportunity arises from Example 8 in the Commissioner's Law Companion Ruling 2016/3. What it says is that you can transfer the business of a trading trust to the corporate beneficiary in satisfaction of an unpaid present entitlement. Obviously, the unpaid present entitlement would need to be less than the value of the business, but in those circumstances, that would satisfy the UPE, so that it eradicates that UPE, and you've obtained the business transferred into a company, hopefully, therefore limiting the UPE issues going forward. Although just having your business in a company doesn't eliminate all UPE issues. Obviously, you'd need to look at the other requirements, and ultimate economic owner is one of those requirements that we'd need to consider in order to know whether this would apply. So what would happen at the end of this is that we would have effectively a dormant trading trust, and our beneficiary co would own the business, and there would be no Division 7A loan between them because of that UPE that was created in an earlier year. The other option is that the trading trust sells the business to a company, and in that case, we would look at utilising the small business concessions that we talked about in the paper by Adrian just before. So the trading trust could be the shareholder in the company, or it could be another trust. The sale price would be the market value of the business, and if we needed to use the small business retirement exemption, we might look to defer consideration until a later time, so that if we didn't have enough money to put that money into superannuation now, we could make that payment at a later time, and at that time put the money into superannuation. So again, Adrian just took you through all of these concessions. They are detailed in full in your synopsis, but we would be able to utilise those concessions if we meet, obviously, the basic requirements. Another option is looking at a licensing agreement. Particular sectors use licensing agreements more than others, and there can be some difficulties in using them, but the things that we need, well, the arrangement is effectively a contract between the business trust and a company that operates the business. Where they fall into difficulty is where you have a difficult time justifying the contractual link between the two parties and the payment system between them. Oftentimes regulators may take the view that what you've actually done is transfer the business rather than merely license the business. And evidence would need to be proven or shown and proven that it is a contractual arrangement, not a sale by stealth. Obviously, there may be CGT and stamp duty issues if a regulator took an opposing view that it was a transfer. And you need to look at, matters to do with, the times these questions come up is when you might register for payroll in a new entity because your employees have gone from a trading trust over to a company and the stamp duty office is asking, well, where's the sale? Where's the duty on the sale? So there is a bit of caution needed with that structure, but it is something that is available at times. So for clients who don't want to change structure, obviously we have the regular Section 109N compliant loans. You probably deal with those every year. We, through your LRC membership, have the ability to access our 109N compliant loans. I think they're $50 or something, relatively low like that. But you would use them regularly. The other ideas or the other options are a sub-trust under the Commissioner's rulings, dealing with existing loans from pre-97 if there are, and some options for dealing with pre-09 quarantined UPEs, and our sub-fund agreement. So in terms of sub-trusts, the Commissioner's ruling and his practice statement allow us to put in place two types of sub-trusts. One is a 7-year interest-only sub-trust and a 10-year interest-only sub-trust. Towards the end of the life of those sub-trusts, the Commissioner realised that a lot of people would be getting to a point where they have to pay out the capital amount that's under sub-trust. So he released Practical Compliance Guideline 2017 number 3, which seemed to say that it does say that you can convert your 7 and 10-year sub-trusts to a new loan, which starts now, which in effect gives you 14 years or perhaps 17 years to repay the capital of that amount. Now that is an opportunity that would seem to change under the new legislation, but again, we'll wait and see what that looks like. But at this point, that is still an opportunity to delay the payment of that principal amount, notwithstanding we need to document it in order to make sure we meet the guidelines the Commissioner has and fit within his ruling. So there's some draft timelines in relation to sub-trusts. Obviously, that is on the basis that there is no change in law. It may be that a full repayment of those amounts, if we continue on the current methodology, a full repayment of that amount may be not due till June 2036. Obviously, if there is a change, it depends on when that change comes in. If they don't change it this year and they elect a sub-trust, well, that sub-trust might run for a few years and then be able to convert to a loan. So again, a bit of caution because the sub-trust documentation must be in line with the practice statement, and clearly the ATO is active in this area to ensure compliance. Division 7A is one of their pet peeves, and they have a lot of compliance in that area. So dealing with pre-1997 loans, to be honest, I haven't seen a lot of them at all. There may be some still around. Debt forgiveness does not give rise to a deemed dividend under Division 7A for those loans. Obviously, it should be formalised by documentation and advice, but the Commissioner has confirmed that that will be the case. In terms of pre-December 2009, or the so-called quarantined UPEs, we know that if the change of law comes into place, those UPEs will convert to loans on the start date of the legislation. So what to do with those UPEs? Now, the Commissioner in TR 2010/3 effectively said that UPEs to private companies were loans. He did exclude that application to pre-December 09 UPEs, but notwithstanding that he excluded it, probably more for practical reasons, that ruling is still binding, and the ruling says that UPEs are loans. So administratively, the Commissioner has disregarded those loans, but even though they were loans, but the deemed dividend still occurred. So if they are loans, which the Commissioner says they are, they were a deemed dividend at a particular time. And that time, I think the next slide has a timeline, but that time is probably, if we're looking at 2009, there we go, there is a subsisting UPE converts to a Division 7A loan in the following year, in May 2010. By 15 May 2011, the trustee must pay out the loan, put it on subtrust, or put in place a compliant loan. That didn't occur for those UPEs, so therefore they were a deemed dividend at that time. Obviously, the following date, the following year, May 2012, is the likely date of lodgement of that return. Obviously, we need to confirm what the date of lodgement is, but our 4 years runs from that time. Now, we're talking 2020, where unless your company, or trusts, I should say, haven't lodged tax returns in 4 years, well and truly we're outside any period of amendment that the Commissioner might have in relation to those loans. So that leads us to a question well, what can we do with those loans in the circumstance that they have already been a deemed dividend? Oh, sorry. So 109G3 protects the forgiveness of a loan if it was taken to be a deemed dividend in an earlier year. And as we can see, the deemed dividend has occurred in an earlier year. So the forgiveness of that UPE, or that loan, will not attract a deemed dividend in the current year. But obviously, advice about the circumstances and the timing and generally advice in this area is crucial, and your clients, if they have Division 7A loans or UPEs of that nature, they should seek advice about their options in relation to whether they can forgive those amounts. So the final option today is a sub-fund agreement. We've called this previously a corporate participation agreement or different types of joint venture agreement, but the circumstances are the same. Our trading trust has a UPE in favour of a corporate beneficiary, and the first step is that it pays out that UPE, and it uses a bearer promissory note, like we talked about earlier in the day, to pay that amount. So the UPE is paid, and the corporate beneficiary then invests that amount with the trading trust in relation to either a specific asset of the fund or all of the assets of the business. So that investment is a contractual agreement, not too dissimilar from perhaps a joint venture in relation to land or other types of joint ventures, but it's a contractual agreement in relation to receipts from an identified asset. Our UPE no longer exists because it's been paid out by money, so therefore TR 2010/3 is no longer relevant. What we've tried to do in our sub-fund agreement is mirror example 8 in the Commissioner's ruling, albeit that we do it outside of Division 7A, whereas that example is still within Division 7A by paying out the UPE rather than just putting that portion of that asset on subtrust. We have tried to mirror it in a contractual arrangement which sits outside Division 7A. This sub-fund agreement is not impacted by any of the changes that might come through. This agreement will operate whether the changes come into play or not, and it can be in circumstances where a new UPE would be a straight loan. Well, that amount could be paid out and reinvested under the sub-fund agreement rather than constituting a loan. So these are some of the issues that we address when we have designed this document. Obviously, Division 7A is crucial, but Division 7A in the context of the interposed or targeted entity provisions. Section 100A, which is a favourite of the Commissioner at the moment in relation to reimbursement agreements, CGT and stamp duty. So broadly, the payment of the UPE from the trading trust will obviously be a payment, and it will be a deemed dividend unless there is an exception that applies. Sorry, that's the payment from the company to the trading trust. So there is an exception in section 109J which says if the payment is made in discharge of a pecuniary or money obligation and it's an arm's length amount, then it will not be a deemed dividend. And that's why the drafting of our document is critical in that it takes into account that it creates that pecuniary obligation and the payment is an arm's length amount that you would expect to see if they were not related parties dealing with each other in relation to a similar contract. So again, target entity provisions are where which can come into play. It's where a company makes a payment or loan to an interposed entity as part of an arrangement for that entity to make a payment to the target entity. So it's where you might have a UPE in favour of a private company and the trust then makes a capital distribution to a shareholder in that company. Obviously, that will not occur in this circumstance because the investment, while it is a payment, it is not made through interposed entities as part of an arrangement to make it to an ultimate shareholder. So what is the arrangement here for those provisions? The target entity provisions only apply if the loan to the target entity is part of the same arrangement as the investment by the company. Obviously, we don't want to make sure that we have payments made out of the trust to individuals out of the money we're using for that UPE. But if the arrangement is done in a proper way and done for the right purposes, these provisions won't apply. Section 100A was originally designed for trust stripping, and it is in relation to a reimbursement agreement. It applies where there's an arrangement to make a beneficiary presently entitled to income, and there is going to be a benefit to someone other than that beneficiary, including the trustee of the trust. And the purpose of the transaction is tax avoidance. And obviously there is an exclusion for ordinary family and commercial dealing. Now that particular exclusion has had some debate and commentary in recent years because the Commissioner has had an increased activity in Section 100A. So in this circumstance, you might consider 100A applies where a beneficiary who might be a foreign beneficiary who might not pay tax is made presently entitled to income. That beneficiary has an agreement to pay the money to their father, for example, back in Australia, and the purpose of it is no one's going to pay tax on that money and dad will get the full benefit. In those circumstances, Section 100A might apply. That's not what we're talking about here. What we're talking about here is a payment of the UPE to the beneficiary who is entitled and has paid tax or will pay tax. And that beneficiary saying to the trustee, well, let's get together and invest in relation to that asset. Rather than the trustee sell that asset to pay the entitlement in cash, the beneficiary will invest in that asset and take a split of the income from that asset. I kind of have talked about that, but effectively, there is no agreement to make someone presently entitled. It's not tax avoidance. We're paying the right amount of tax, and it would, we say, fit under the ordinary family or commercial dealing exception, similar to a mum and dad UPE, where they don't call for that money to be called through. That is what that ordinary family and commercial dealing is designed for. CGT and stamp duty. There is a CGT event D1, which applies to giving someone a contractual right. But there is an exception there which says if your agreement is that a later CGT event will occur, you don't pay CGT on the creation of the right. So the agreement says at the end of the life of the subfund agreement, the asset will be sold, which would cause an A1 event. Because that is the nature of the agreement, that asset will be sold at the end of the subfund agreement, then D1 doesn't apply upon the creation or upon entering into the contract. Stamp duty, there is no dutiable transaction here. All there is the passing of money. We've passed money using a bearer note from the trustee to the corporate beneficiary, and it has passed that money back to the trustee, and they've entered into a joint venture contract together in relation to a particular asset. Again, I said CGT occurs on realisation of the asset when the subfund agreement occurs, and the corporate beneficiary shares in the income and capital receipts. So the capital receipts on realisation, therefore it shares in that capital growth in the CGT asset. Obviously, some of that capital growth is obviously in a company, therefore it doesn't get access to the discount gains. So there are some downsides to that. However, the balance of that growth is taxable to the trustee, who is eligible for the CGT discount. So again, finally, change is coming. We're not exactly sure when it is. It is, according to last year's budget, it is scheduled to come in on 1 July 2020. We hope that's not the case. We hope there's some sensible rethink of that. There are options available if your clients wish to get out of their current structure, or if they're happy with their structure but want to deal with their Division 7A entitlements in a more effective manner. Any questions?
Thanks, Paul. We do have some questions here, and we've got enough time to cover them. Some I'll cover myself, just to make it easier in terms of time. First one relates to the earlier paper. Does the CGT retirement exemption amount need to be paid out in cash, or can it be journaled? There does need to be a payment. We can't just journal it. We can pay it by cheque, believe it or not, or bearer note, but we do have to honour that cheque or cash that cheque in a reasonable period. Paul, is now an opportunity for companies that do not have distributable surpluses to forgive Division 7A loans?
Yes, with proper advice. So it will depend, but one of the consequences of the removal of distributable surplus is that if that forgiveness were available under the current law, that will change. So it's worthwhile at least exploring the option of whether that is a suitable option for those clients.
Okay. I'll answer this one. Any suggestion on how to deal with a debit loan account from 2018 where the previous accountant didn't put anything in place? There was a distributable surplus that year, but it is less than the loan. Whenever you're fixing things up, and we do give a bit of advice on this when people have inherited clients, first thing to have a look at is the commissioner outside the period of amendment to do anything? If not, do we do anything in terms of coming forward to the Commissioner? There are opportunities there for the Commissioner there to exercise discretion under Section 109R. However, this is not going to be an answer. It will depend on the circumstances, but really it goes back to what's the period of amendment, when did the dividend arise, if it arose, what was the distributable surplus, do we actually need to do anything, or can we just leave sleeping dogs lie, so to speak, on the basis that it's out of time now. Paul, just wanted to clarify one thing. If a loan was made in an earlier year and at the time of the loan there was no distributable surplus, then the forgiveness of the loan in a later year is not subject to Division 7A. So in other words, the key issue is whether there was a distributable surplus at the time of the loan, as opposed to whether there was a distributable surplus at the time of the forgiveness.
Yes, that's correct. So that answers it in a nutshell. It needs to be if there was no distributable surplus at the time of the loan. Yep. Therefore, there in effect was a deemed dividend. It was just limited to the amount of the distributable surplus. And 109G3 says that if you forgive a loan that was a deemed dividend in an earlier year, that forgiveness will not be caught by Division 7A.
Thanks. There's three other questions, but bearing in mind time that we're scheduled to finish at 5, we'll take those offline and answer those directly to the people that asked. Paul, you've got to stay on camera. I don't think you know, but I'm going to throw to Brett, who will give us our closing remarks.
Righto, thanks gentlemen, and thank you to everyone for chiming in this afternoon. It's a long time to be looking at a computer. I probably will just take you back to where we started. Hopefully through today you've seen an example of what we do. That is, we deliver specialist knowledge, well leveraged, as we're looking at it now, and easily accessed. And certainly hoping to get back to some level of easier access than across the interweb as soon as we can, and live up to our motto that we do get out from behind the desk, although not today. So thank you very much. All of this has been recorded and it'll be made available either on our website or through another platform. We'll talk about that in the next day or so. For those of you who want to watch bits of it again, or for that matter, if you've got specific queries or like more information on anything we've spoken about today, please email us and we'll deal with that very quickly. You'll get some feedback emails from us this afternoon. We do value your feedback and it helps us shape future topics, and we're foreshadowing that all things being equal, we ought to be back on the road and have a better ability to be in front of you in October and toward the back end of October in particular, and looking at some workshops around the third week in October and a little later. I've had about 220 people log in today from time to time, and thank you for those who've been able to stay with us most of the time. It's a long haul. We do appreciate your support and look forward to your feedback, and we're also looking forward to some improvement in the economic conditions and our world generally for the rest of 2020 and into 2021. So thanks to the speakers, thanks to our hosts, Redback, and we look forward to connecting with you guys and girls again shortly. Thank you.